The Eastern Economic Forum in Vladivostok is usually a stage for Russia to showcase business deals and woo Asian investors. But this year, it delivered a bombshell, and it came from the lips of Anton Kobyakov, a senior advisor to President Vladimir Putin. Speaking to reporters, Kobyakov claimed that Washington plans to rewrite the rules of gold and crypto markets, push the world into a crypto cloud, and then shift part of America's massive national debt into that cloud. Once that happens, he suggested, the United States will devalue the debt and start from scratch. What does that even mean? Is Kobyakov just spreading propaganda, or is there a grain of truth to his warning? To find out, we need to unpack several complex ideas. The size of America's debt, how inflation can silently reduce that debt, why stablecoins have become central to Washington's financial strategy, and why even crypto evangelists like Michael Saylor think the United States should ditch gold for Bitcoin. This video dives deep into those questions, using the latest facts and figures to show how the next financial battlefield may not be fought with bullets, but with bits and bytes. A $37 trillion debt and a Kremlin warning. Let's start with the numbers. On 12th August 2025, the Committee for a Responsible Federal Budget reported that the United States' gross national debt had just crossed $37 trillion. That milestone means that America's obligations now exceed the entire size of its economy. Debt held by the public has risen to around 100% of GDP. The debt has ballooned because Congress and the White House keep running large deficits and adding new borrowing. Interest costs alone are on track to hit $1 trillion a year. So, when Anton Kobyakov accuses Washington of looking for a way to make its debt disappear, he is pointing at a real problem. In his speech, he alleged that the United States plans to move part of its debt into dollar-pegged digital tokens called stablecoins and then devalue it. According to a translated summary of his remarks, he said Washington will manipulate crypto and gold markets, write new rules, and push the world into a crypto cloud. Put simply, Kobyakov explained, they have a $35 trillion debt. Over time, when part of this debt is placed in stablecoins, the United States will devalue it and then start from scratch. Is such a scheme even possible? To answer, we need to understand how debt devaluation works and why digital money could help achieve it. Inflation, the oldest trick for shrinking debt. Imagine the entire world consists of just one $100 bill. If a government borrows that $100, it owes the whole economy. Paying it back at face value would be difficult. But what if the government could create another $100 bill out of thin air? Now, there are two $100 bills chasing the same amount of goods and services. Prices double because each dollar is worth half as much. When the government returns one $100 bill to its lender, the lender technically gets the same nominal amount back. But in real terms, the lender's purchasing power has been halved. That process is called debt devaluation. You don't default, you repay your debt with money that has lost value. Economists call this a monetary devaluation or inflationary finance. Monetarist theory explains that inflation is caused by too many dollars chasing too few goods. When the money supply grows faster than the supply of goods, each dollar's value falls. The quantity theory of money formalizes this relationship. Money supply multiplied by its velocity equals nominal expenditures. MV equals PQ. So prices can rise if the money supply or its velocity increases while output remains constant. Put differently, inflation is a hidden tax on everyone who holds cash or fixed rate debt. The United States has used inflation to shrink debt many times. After World War II, inflation reduced the wartime debt burden. During the high inflation 1970s, the real value of outstanding bonds was eroded. More recently, the massive money printing and stimulus during the COVID-19 pandemic drove consumer prices up and effectively lowered the real value of government liabilities. And because US debt is issued in dollars and the Federal Reserve controls the printing press, Washington has more leeway than other nations to inflate its way out of trouble. But inflation harms ordinary citizens as their wages and savings lose value. Can the US export some of that pain to the rest of the world? That's where stablecoins come in. Stablecoins, digital dollars with treasury backing. Stablecoins are privately issued digital tokens that are designed to maintain a constant value, usually pegged 1-to-1 to the US dollar. To keep the peg, issuers hold reserves of safe assets like US Treasury bills and repurchase agreements. Roughly 80% of the stablecoin market's assets are invested in short-term US Treasuries or repos, and the largest issuers hold well over $100 billion of treasuries. The combined market capitalization of stablecoins is about $256 billion. If the US Congress's Genius Act, the first federal law regulating stablecoins, stimulates adoption, the market could swell to $2 trillion by 2028. Under the Genius Act, only regulated entities such as banks, trust companies, or specially licensed non-banks may issue payment stablecoins. Issuers must hold high-quality liquid assets, primarily US dollars and short-term treasuries, to fully back every token. Algorithmic or unbacked stablecoins are effectively banned. The law also directs the Treasury to supervise reserve disclosures and authorizes the Federal Reserve to oversee stablecoin payment systems. These requirements ensure that stablecoins are essentially digital IOUs backed by US government debt. Every time someone in Asia or Africa uses USD-pegged tokens to pay for goods, they are indirectly funding the US government because the issuer holds treasuries to back that token. Why would anyone hold these tokens instead of dollars? The answer lies in ease of use and global reach. Stablecoins settle instantly across borders without the fees or frictions of traditional banking. They are widely used by crypto traders, remittance providers, and increasingly companies moving money around the world. A large share of stablecoin transactions happen outside the United States. For Washington, that's a strategic advantage. Foreign users provide a steady demand for US debt. As adoption grows, stablecoin issuers must buy more treasuries, keeping borrowing costs lower for the US government. At the same time, if the US inflates the dollar, the value of every stablecoin falls because each token is still worth $1 but buys fewer goods. That means the cost of inflation is exported to anyone around the world holding these digital dollars. It's like splitting the hidden tax among global users rather than imposing it solely on American citizens. How could a crypto cloud devalue debt? Kobyakov's theory about a crypto cloud suggests that Washington might go beyond just issuing stablecoins. He implied that the US could securitize or tokenize parts of its $37 trillion debt, put it into a blockchain-based system, and then manipulate the token's value. In practice, that could mean issuing stablecoins backed by treasury bonds and then inflating away the underlying dollar. Consider this simplified scenario. The Treasury issues $1 trillion of stablecoins, each backed by $1 trillion in short-term treasuries. Foreigners and crypto investors snap up the tokens, confident that each one is redeemable for $1. Over time, the US prints trillions more dollars to finance deficits, causing general price inflation. When holders eventually redeem their stablecoins, they still receive $1 per token, but that dollar now buys far less. The Treasury repays its obligations in nominal terms, but has effectively reduced the debt's real value via inflation. And because millions of tokens are held abroad, the pain is shared globally. Is this purely hypothetical? Stablecoin demand is already driving massive purchases of US treasuries, and the Genius Act's regulatory clarity aims to scale that demand. Unlike a traditional central bank digital currency, which might be issued directly by the Federal Reserve, stablecoins operate through private companies and regulated institutions. That distance gives Washington plausible deniability. It can say, "We're just regulating innovation," while quietly letting a larger slice of its debt be held in token form. Why are central banks buying gold instead of stablecoins? If the US is pushing digital dollars onto the world, why are other countries stocking up on gold? The European Central Bank's 2025 analysis on international reserves notes that central banks bought more than 1,000 tons of gold in 2024, roughly double the recent decade average. Global official gold reserves rose to about 36,000 tons, close to the all-time high of the 1960s. Gold now makes up about 20% of global foreign reserves, surpassing the euro's roughly 16% share. Why? About two-thirds of central banks surveyed cited diversification, and a large share cited protection against geopolitical risk. In other words, countries want an asset that isn't under anyone else's control. Kobyakov's conspiracy theory underscores that fear. If the US can rewrite the rules of digital money, it might also weaponize that system. Gold, a physical asset outside the digital network, is insurance against that scenario. The same research also reveals that the US government is building its own digital asset stockpile. The new administration plans to create a strategic Bitcoin reserve by pooling roughly $17 billion worth of seized Bitcoin. The plan also allows the government to aggregate other confiscated crypto assets. And while stablecoins accounted for around $190 billion at the end of 2024, issuers already held nearly $150 billion of US debt securities, comparable to the holdings of sizable foreign creditors. Is the US hedging its bets? On one hand, it champions stablecoins to boost demand for treasuries and export inflation. On the other, it quietly builds a Bitcoin reserve and seizes digital assets. That dual strategy suggests Washington recognizes the strategic importance of digital assets, both as a geopolitical weapon and as a potential lifeline if the dollar's supremacy falters. Michael Saylor's radical proposal, sell gold, buy Bitcoin. While Russian advisors warn about stablecoins, American Bitcoin evangelists have offered a very different solution to the US debt problem. Michael Saylor, co-founder of MicroStrategy, gave an interview in 2024 in which he urged Washington to dump your gold, sell all the US gold, and buy Bitcoin. Saylor argued that the US should sell its entire gold reserve, estimated at roughly 8,100 tons, and use the proceeds to buy around 5 million Bitcoin. According to him, this would demonetize the entire gold asset class, send the price of Bitcoin soaring, and make US assets worth $100 trillion, while adversaries holding gold would see their wealth evaporate. On the surface, it sounds like an audacious plan. By cornering the Bitcoin market, the US could control the world's reserve capital network, Saylor claimed. But is it plausible? For starters, selling America's gold would require political consensus and could crash the gold market, triggering financial instability. Buying millions of Bitcoins would drive the price to astronomical levels and invite global backlash. Moreover, Bitcoin's market is volatile. Using it as a reserve asset could expose national finances to wild swings. Saylor's proposal nonetheless underscores a broader shift. Digital assets are no longer fringe ideas, but part of mainstream geopolitical discussions. Even if the US never sells its gold for Bitcoin, the fact that well-known executives publicly advise such strategies shows how much crypto has penetrated policy circles. Exporting inflation, the hidden benefit of stablecoins. Whether via stablecoins or Bitcoin reserves, the endgame is the same. Find a way to manage America's colossal debt without sparking a domestic crisis. Stablecoins offer a unique tool because they allow Washington to expand the supply of dollar-based tokens beyond its borders. But how exactly does that help devalue the debt? Demand for treasuries. As the stablecoin market expands, issuers must hold more treasuries. That lowers borrowing costs for the US government by creating a new class of captive buyers. Shared inflation. When the Federal Reserve increases the money supply, domestic prices rise, reducing the real value of outstanding debt. With stablecoins circulating globally, foreign holders of tokens also share in that inflation, effectively paying part of America's debt reduction bill. Regulatory plausibility. The Genius Act frames stablecoins as a private sector innovation, not a government CBDC. This approach may avoid the political backlash that central bank digital currencies face while still delivering many of the benefits: instant payments, programmable money, global reach. From a geopolitical standpoint, stablecoins could extend the exorbitant privilege that the dollar enjoys, the ability to borrow cheaply, because the world needs dollars for trade and reserves. In the 20th century, that privilege depended on confidence in US Treasury bonds and the depth of American financial markets. In the 21st century, it may hinge on the world's willingness to hold digital dollars created by US regulated entities. However, this strategy carries risks. If stablecoin issuers fail to manage their reserves properly or suffer hacks, confidence could evaporate quickly. There is no guarantee that reserves are always fully backed. Independent audits are still rare. And the US could change the rules, much like President Nixon ended dollar convertibility into gold in 1971, triggering a dramatic currency realignment. Other nations fear that the US might one day sever stablecoins linked to treasuries or impose sanctions via the digital network. That is why many countries are building their own central bank digital currencies, exploring cross-border payment systems, and hoarding gold. The deflationary nature of technology. There is another important dimension to this debate. Technology is inherently deflationary. Innovations like automation, artificial intelligence, and better supply chains make it cheaper to produce goods and services. In a free market with a fixed money supply, prices should fall over time as productivity increases. That's why you can buy more computing power for less money each year. Author and entrepreneur Jeff Booth argues that the natural state of the economy is deflationary because technology continuously improves efficiency. Yet governments fear deflation because it makes debts harder to repay in nominal terms. So, policymakers prefer a constant rate of inflation and fight deflation with money printing. This tension between deflationary technology and inflationary monetary policy is at the heart of the crypto debate. Bitcoin's fixed supply appeals to those who want a deflationary asset, while stablecoins ride on the inflationary dollar. Are we fighting technology's natural deflation with man-made inflation just to keep the debt manageable? When you look at the economics, that's exactly what is happening. Transparency and the risk of rug pulls. For Kobyakov's crypto cloud conspiracy to work, the world must trust that US-backed stablecoins are safe and redeemable. Yet history gives reasons to be cautious. Stablecoins rely on private issuers maintaining full reserves and being honest about their holdings. There have been controversies. Some issuers delayed audits or faced accusations of inadequate backing. Even when audits are released, they are not always available in real time. What happens if the US government abruptly changes the rules? Consider the 1971 example again. Dollars were once redeemable for gold, but President Nixon unilaterally suspended convertibility, effectively devaluing global dollar reserves overnight. Similarly, a future administration could decide that stablecoins can only be redeemed at a discount, or that certain foreign holders cannot redeem them at all. Because stablecoins are programmable, such restrictions would be easier to implement than in the analog world. These risks explain why central banks are not piling into stablecoins and are instead boosting gold reserves. It also explains why Kobyakov warns of a hidden US scheme. Whether or not his theory is correct, the world's skepticism about US intentions is real. The broader geopolitical game. The debate over stablecoins and debt devaluation is not just an economic question. It's a geopolitical contest for monetary dominance. On one side, the United States wants to preserve the dollar's dominance by embedding it into digital tokens that spread across the globe. On the other, rivals like China, Russia, and Iran are exploring alternative payment systems, ramping up gold reserves and piloting their own digital currencies. At the Eastern Economic Forum, Kobyakov's comments were likely intended to sow doubt about America's digital currency push and encourage other countries to resist adopting US-backed stablecoins. Pointing to a conspiracy about devaluing debt may be propaganda, but it taps into genuine concerns about US monetary hegemony. Meanwhile, American crypto advocates like Michael Saylor are pushing for the opposite. They want the US to leapfrog to a Bitcoin-based financial system that bypasses fiat money entirely. Between these extremes, policymakers are crafting legislation like the Genius Act to regulate stablecoins and harness them for national advantage. And behind the scenes, the US government is quietly building a strategic reserve of Bitcoin and other seized cryptocurrencies. Is a debt reset inevitable? So is the United States really preparing a crypto cloud to erase its $37 trillion debt? The evidence suggests a more nuanced answer. Washington is certainly embracing stablecoins and crafting laws to regulate them because it recognizes that digital dollars can help sustain demand for treasuries and export inflation to global users. That by itself is a form of debt management via devaluation. However, there is no public plan to directly convert federal debt into tokens and then haircut their value. Kobyakov's claim may exaggerate the immediacy of such a scheme. It serves Moscow's narrative that the US manipulates global finance for selfish ends. Yet his warning forces us to confront the ethical and geopolitical implications of America's digital currency strategy. As viewers and citizens, we should ask, who benefits if stablecoins become the backbone of global payments? Ordinary people or the US Treasury? What happens to trust in money when private companies control much of the world's digital currency? Could a future crisis prompt the US to change redemption rules like in 1971? And what role should hard assets like gold or fixed supply cryptocurrencies like Bitcoin play in a world of programmable money? There are no easy answers, but one thing is clear: the struggle over money's future is well underway. Whether through debt devaluation, stablecoins, gold hoarding, or Bitcoin reserves, the choices countries make today will shape the global economic order of tomorrow. And as always, being informed is the first step toward making sense of the noise. If you found this deep dive useful, let us know your thoughts in the comments. And stay tuned for more explorations into the forces shaping our world.